Hey guys, how are you? This is Shawn Anen from Better Homes and Gardens Realty, team leader of the Anen Group, and I'm here with Mark Casamassina today. I've been working with Mark for about 15 years. He's been in the business about 25 years, and he's somewhat of a legend in the mortgage industry. And he's done amazing things over the years for my clients, and he's always looking to help people out. And we just want to bring this to the masses, and give people an opportunity to hear what he has to say, and be able to experience Mark firsthand. So we have a series of questions, and I believe this is actually going to spin off into a series of different videos as well. And so we're just here for you to give you a little guidance on what it's going to take to get a mortgage in today's market. So, Mark, question for you.
Mm-hmm.
I want to start looking for a house. Do I get pre-approved first, or do I actually go out and start looking at houses first? What do you think the best way to attack this?
Definitely get pre-approved first.
Okay.
The last thing you want to do is fall in love with a home and then find out after you speak to a mortgage professional the house doesn't fit your budget. Learn what you can afford, what your budget is, down payment, etc. That would be my advice to anybody. Get pre-approved first.
So in the pre-approval process, what do you think is the most important factor? Like, what should I be doing first? Should I be watching my debt? Look at what I'm spending money and stuff on, or student loans? And
No, it's a great question. The first thing I tell my clients to do when I talk to them on the phone is, why don't you go through your checkbook for the last 3 months, see where you're spending money, see how much money's coming out of your checkbook each month, how much you have left over to save, so we can get an idea of what we think you can afford. So when you walk in and sit down with me, the first question I'm going to ask you is, where's your comfort payment? Where do you see yourself as far as a mortgage payment is concerned? Then I'm going to ask the next question I'm going to ask you is, what price range do you see yourself in? I'll know right away where a client's thinking, that the numbers match. Because a lot of times people come in and talk to me and their first question is, well, I don't know what I can afford, that's why I'm here to sit down with you. So I would tell them, go through your checkbook, get an idea of what you're spending every month, and then we kind of talk about it, and I try to get them to tell me what they can afford before I actually tell them what they qualify for.
so you kind of like back the numbers in,
Yes.
to what they're comfortable
Yes.
paying, which is great.
Yes.
So you're not just gonna go stick a pre-approval, for some, absorbing them out if these people aren't comfortable.
Nah, I can't. I know them for 15 minutes.
Gotcha.
How many times a week do they go out to dinner? I had a client one time tell me they're going to quit smoking and they're going to save $75 a month on cigarettes, but that's the way he budgeted his money.
Right.
Do you go on vacation 4 times a year? Do you go on vacation once a year? So I need the client to tell me a little bit about themselves. It's just not numbers. It's it's real. It's your life.
Gotcha. Cool. All right. So now that I'm thinking about finding a house and stuff like that, I want to get pre-approved. There's so many different online mortgage calculators out there. So many different sources of information and resources to you can afford this, you can't afford this, and this number here and this number here. Are there benefit to those online calculators? Are those numbers pretty accurate? And is there something that gives you somewhat of an idea to be able to see what you qualify for?
Definitely can get an idea. Definitely can gather information with an online calculator. My opinion is, with an online calculator, it's only as good as the individual on the other side that's typing in the information, asking the computer the questions. An online calculator doesn't know what your credit score is, may not have the right factor for PMI if you're putting down less than 20%. So I think it's a great start for a client to get an idea of what the numbers are, but I think they should go talk to their realtor to get a recommendation to a mortgage individual to really speak to somebody first before they trust what a computer tells them.
Gotcha. And I heard you mention PMI. Could you just explain what PMI is for, and the great thing about you is you're able to put things in like very layman's terms, like very simple, relatable terms. So on the PMI, just explain a little bit what PMI is.
PMI, yeah. PMI is an acronym for private mortgage insurance. For a client that puts down less than 20% for a conventional mortgage, they're going to be required to pay some form of private mortgage insurance, PMI. Once they get to 20% down, PMI would not be required to be paid. So it's required because Fannie Mae guarantees a lender up to 80% of the value of a home. Above the 80%, Fannie Mae requires the client to obtain private mortgage insurance to insure the difference of the 80% loan to value to what they're borrowing, so that the lender is insured in the event a client goes into default. So it's mortgage insurance that insures the lender, not mortgage insurance that insures the client in the event they got hurt on a job or somebody passed away.
Gotcha. And I'm sure people out there have heard Fannie Mae and all this other stuff. So just in like a 10-second description, what is Fannie Mae? Is it like a governing body over the insurance lending process? What is Fannie Mae?
Yeah, Fannie Mae and Freddie Mac are two government agencies that guarantee a lender in the event a client goes in default.
Gotcha. Cool. Okay. So what would actually be my first steps in getting pre-approved? Do I pay off some debts that I have? If I have student loans, if I have another house, how does that work as far as, paying off that house to be able to qualify for the next loan? How does that work?
I would say going back to what we said earlier, go through your checkbook, get an idea where you are with your bills, think about a budget, find a comfort payment that you think you like and a price range, and then sit down with a mortgage professional. Sit down with somebody that can go through everything with you, talk to you about what your income is, how long you've been on your job. I want to review your W-2s and federal tax returns that go back over the last 2 years. I want to see your pay stubs for the last 30 days, and I want to see your bank statements for the last 2 months. I get an idea where you're at. I run your credit. I go through all your debts with you, and may at that point tell you, hey, in order to qualify, we need to pay off this credit card, or we need to pay off this car payment, or this loan is a lot of times people co-sign for a loan for their children and or a friend. Well, who's making the payment on that? And then can we offset that debt to help them qualify for the mortgage they want to get?
Gotcha. That's great. And I can vouch for personal experiences where people had debts that they had to pay off. That let's say that they had a credit card with a $5,000 balance, and their payment was $150 a month, or whatever the number would be. That they paid that off, and they were able to qualify for more of a mortgage. And that was, per your recommendation to do that.
Correct,
to be able
correct.
to afford a house.
Sometimes they have an installment that they use to pay off their credit cards, and they said, okay, I'm going to get rid of all this because I'm going to buy a house. They did a $10,000 loan to pay off all their credit cards. They have a $400 payment. It's done in 3 years. And I may say to them, hey, pay that off because that $400 equates to $90,000 in buying power.
Is all debt created equal? Like, is there, let's say you have, $50,000 in student loans versus, $30,000 in credit card debt. Does the back end of your mortgage qualification system give different grades to different stuff, as far as the debt?
Student loan debt, if you're doing an FHA mortgage, totally different conversation. We'll get into that later. But for the most part, credit card debt could affect your credit scores, because what the credit reporting agencies look at your credit limit to your credit balance. And if you exceed 50%, in other words, if you have a $1,000 credit limit and you owe $600 on your credit card, you're above the 50% threshold, that may affect your credit scores. So I would say if you're going to manage your credit, you want to try to keep all your credit card balances on any given day of the month below 50% of the credit limit, because that'll help get their credit scores up. And then your student loans, they're usually installment debts. You have a payment, you make a payment on time, it just registers the same as a car loan, and that'll have a positive effect on your credit because you're making your payments timely.
Interesting. Speaking of car loans, a question that I've always wondered, and there's people who love to lease, hate to lease, rather buy. Does leasing over buying a car make a difference when getting a mortgage?
The only time it makes a difference is if the lease payment has less than 10 payments to go on it, it still counts as a debt when you're qualifying somebody for a mortgage, whereas if a car payment has less than 10 months remaining on it, it doesn't necessarily count as a debt against them when you're qualifying for a mortgage, because it's assumed you're going to pay off that car and you may not have a new car payment for a couple of years. Whereas a lease, when the lease payment's up, you have to give back the car.
Correct.
So you have to get a new car, so there's assumed that the payment's going to continue in some capacity.
Gotcha. Okay. So if somebody's buying a house and they're coming to the end of the lease, they can jump into another lease and it will not affect
It
them.
will not affect them.
Got it. Okay. But if I'm paying off one car and I'm being approved for a mortgage in the last 10 months, I don't go and buy a Lamborghini that's going to put me, way over some kind of.
Correct. If you're going to get a new car, try to keep the payment the same as the old car, so that when we qualify you, there's no major change.
Gotcha.
6 months down the road if it took you a while to find a home.
Cool. And so I've heard you say FHA, conventional, a couple times. So I guess, my question is, what's the difference between an FHA and a conventional loan, and why would I want to go with one over the other?
A lot of variables here. My first response with an FHA loan is they're more forgiving with credit. Each government agency, whether it be the FHA or Fannie Mae and Freddie Mac, have different rules when it comes to bankruptcies, foreclosures, even charge-offs and collection accounts. The FHA is more forgiving on bankruptcies and foreclosures. They're going to say a bankruptcy can be discharged for 2 years and a foreclosure 3 years from the date that the bank takes the property back from you and you're eligible for a mortgage. Whereas Fannie Mae, it's 4 years for a bankruptcy and 7 years in most cases for a foreclosure that you're eligible for Fannie Mae financing. So I would say, yeah, if your credit if you went through a tough time over the last few years, which a lot of people have with the housing crisis in 2008, and they went through whether it's a short sale or a bankruptcy or foreclosure, FHA may be a great option. FHA is also more forgiving with interest rate with a lower credit score. Whereas Fannie Mae, the lower the credit score, the slightly higher the rate will be. Same with the PMI factor. If you're putting down less than 20%, the lower the credit score, the higher the PMI is going to cost you with a conventional loan. Whereas whereas the FHA, the PMI factor is the same whether you put down 3.5% up to 5%, and then if you put down 5% or more, the PMI factor goes down slightly. So it's not a big difference, and it doesn't matter what your credit score is.
Gotcha. And for some people that are actually concerned with the PMI, the private mortgage insurance, I believe you guys offer some programs that can pay the PMI, ahead of time.
Mm-hmm.
Is that
Yeah, there's two versions of it. It's called borrower paid PMI, where you make the loan amount slightly higher, or the borrower just pays either you make the loan amount slightly higher, so the borrower basically finances the cost of the PMI up front, or they pay it up front at the closing, or there's something called lender paid PMI, where the rate is slightly higher, and as a lender, we give them a credit to pay the PMI up front.
And correct me if I'm wrong, but the advantage of going with something like that is PMI is not tax deductible, but the interest rate is.
Well, as of today, and a lot's changing with the tax reform and everything else, interest you pay on a mortgage today is tax deductible. Going forward, it may still be tax deductible. The tax reform's still in the
Right.
Yeah, exactly. So
Still
there's
not limited amount.
exactly a lot of changes going on there, but it still should be tax deductible for most, I believe. But let's find out in January.
That's a new episode, by the way.
Yeah.
There's another episode.
But with PMI is tax deductible today as long as a client makes up to $109,000. They can still write off PMI.
Okay.
It phases out at $109,000. Where if you make more than $109,000, if you're paying PMI, it's not tax deductible. One of the advantages of going with lender paid PMI or borrower paid PMI usually helps your client qualify for a little bit more money in a mortgage, because the slightly higher interest rate may help, even though you're paying a slightly higher rate, it's still cheaper than paying the monthly PMI. So that may help them get $20,000, $30,000, $40,000 in buying power going forward when they buy a
That
house.
much?
Yeah, good.
Okay.
It could.
Well,
It could. Most people don't want to pay the higher rate because that's for the life of the loan, whereas PMI goes away.
Gotcha.
Eventually, PMI will go away.
And that's once you build up 20% equity within the house.
Yeah, there's some rules with the government with that, but 20% equity, you can make a phone call to get rid of PMI. When you get to a 78% loan to value off the purchase price, it goes away automatically.
And to clarify, that's on conventional.
Conventional only.
So on FHA, the PMI.
With 9.9% down or less, you pay PMI for the life of the loan.
Okay.
With 10% down or more, PMI goes away in 11 years.
But you can refinance out of that.
Always have an option to refinance down the road.
Or
Yes.
when you sell the house, obviously.
Correct.
Not on the hook.
Correct.
Gotcha. So that's great. No, that's good stuff. And speaking about rates and what affects these rates, the FHA, the conventional, how they differ, down payment, credit, and all that stuff.
Mm-hmm.
We've kind of hit on what affects the rates. How do I get the best rate possible?
I'm going to answer that question in a second. The one last thing I want to add about FHA. The FHA allows a client to buy a home with as little as 3.5% down, and that's a 1 to 4 family home. So as long as it's owner occupied and your client's going to live in the home, they can buy a 1 family, 2 family, 3 family, or 4 family home owner occupied with as little as 3.5% down.
And you can finance up to how much in closing?
You can finance up to 6% of the contract price towards closing fees.
Okay.
So in that scenario, if they bought a house for $300,000, they can put down $10,500, finance all their closing fees, and come out of pocket with $10,500 and buy themselves a 1, 2, 3, or 4 family home.
Gotcha. That's great. So if anybody is looking out there to, hey, you got some less money in your pocket, as long as you can qualify, it's a great option.
It's actually tremendous. Most people are afraid of the FHA loan, and
Yeah.
the qualification process is exactly the same as a conventional loan.
The old adage was that the appraisals were tough and there were stringent guidelines and all this stuff. And, hey, I've been doing this 15 years and, knock on wood, I mean, the only crazy thing that I've ever had during an FHA appraisal is, scraping paint, some, chipping
Correct.
paint on a railing or
Correct.
something like that.
Correct.
So,
The other great thing about the FHA too is their debt to income ratios today. They allow somebody with more debt to qualify for a little bit more of a mortgage than with a conventional loan. So because the debt to income ratios are a little less strict, you can go up to a 56% debt to income ratio, which means in simple terms, if your gross income's $10,000 a month, you can have total debts, including your mortgage, to equal $5,600 a month and still qualify for a mortgage.
gotcha. But if somebody did want to go conventional, let's for whatever reason, can they still, Does conventional offer 3% down?
Yes.
Is it minimum 5 or?
No, conventional offers 3% down.
Okay.
Great
I
option.
think they would have to compete with the FHA because if they didn't.
Exactly,
they'd lose the
exactly, exactly. If your credit scores are higher, 3% down conventional generally is a better option. But if your credit scores are lower, you're better off doing 3.5% down and going FHA. The drawback to the conventional with 3% down, you only can finance up to 3% of the closing fees, the
PMI
closing
might be higher
costs,
though as well.
and the PMI is going to be higher. So in most cases, the PMI is higher. So I would say
But the PMI can come off.
the PMI goes away, whereas FHA doesn't go away. Correct.
Got it. Okay. So there's some advantages and disadvantages. I mean, the best, the people with the higher DTI or debt to income ratio are better off with an FHA.
Correct. Correct. A lot of times when I put somebody in an FHA loan to a conventional loan, we don't always worry so much about the PMI because the average person stays in a home 5 to 7 years.
Right.
So if you put down 5%, you're going to pay PMI with a conventional loan somewhere between 9 and 11 years.
Gotcha.
Same as the FHA loan.
And so you said if you have a down payment of 9.9% or higher, the PMI goes away.
10% down or more, PMI goes away in
If you
11
go
years.
with FHA.
FHA.
Gotcha.
Yes. Yes.
But most people that are doing FHA are sticking with a 3.5% down.
Correct.
Okay.
Correct.
Got it. Cool. So back to the rates.
Credit score.
Okay.
Pay your bills on time. Higher your credit score, better the interest rate.
Gotcha.
Lower the credit score, higher the interest rate.
FHA and conventional.
Yes, yes. Conventional more strict than the FHA. The FHA, you can have a 640 credit score and basically get a rate today of around 3.5%, 3 5/8. If you had a 640 credit score conventional, you might get a rate between 4 1/8 and 4 1/4.
Okay.
So, and the PMI will be higher with a conventional loan with a 640 credit score than it would with an FHA loan with a 640 credit score.
Gotcha.
So it all depends on the numbers and what somebody's long-term needs are. You know, when I talk to somebody,
Man, rates are still great today.
unbelievable.
It's crazy.
Can't believe they're
House
still
prices.
the
Hey, look, the market's going up. Prices are going up. They're still affordable. They're not anywhere near 2006, 2007 prices. So, the affordability factor is, tremendous.
Mm-hmm.
I remember my first house, my interest rate was 6.5%, and that was great back then, 2006.
Mm-hmm. Yeah,
You know?
it was.
So, when the house price was through the freaking roof.
Correct, correct. When I started in the business, rates were over 9%.
Yeah.
So
I hear so many people, back in the 80s or
Yep.
70s, I paid 18%, and
Yep.
so
Rates are low today. In my eyes, rates are low today.
where do you see the rates going in the near future? What's the trend here?
Short term, I think rates are going to stay stable, slightly tick up. A lot's going on today in the government with the tax reform, so a lot still to be told. Economy's doing well. It's the holiday season, so retail sales have an effect on interest rates. Home starts, things along those lines. I worry about interest rates day to day. I can't predict the future. I don't have a crystal ball. But I believe they're going to stay in this range, maybe tick up a little bit. But that's on the short term. I can't predict any further than maybe a month out, you know.
So they were, correct me if I'm wrong, but they were always kind of tied to the 10-year Treasury, but has it kind of gotten away from that a little bit? It's more so into...
They're still
just
tied to
what's
the
going on?
10-year Treasury. We watch what's called mortgage-backed securities to see what's going on. They trade it back and forth. It's a traded commodity.
That was the kind of thing that...
Yeah, the 10-year
market
Treasury...
down, CDEs, whatever those things were called back in the day.
Yeah, exactly, exactly. But the 10-year Treasury is a great thing for a consumer to look at. If they see that number going up, rates are going up. If they see that number going down, rates may tick down a little bit.
Okay.
So, just for the average person to look at.
And that's something you watch every day. They have a ticker for it. It's
Yeah.
like, almost like watching like a stock. kind of.
Yeah, I look at the mortgage-backed securities just to get an idea what the day's doing, but I don't control rates, so
Yeah.
I come in the office in the morning, that's the rate today, and that's what I focus on because I don't know what it's going to be tomorrow, and I can't change what it was yesterday.
Cool.
You know.
Very cool. So I think that wraps it up for me. Do you have anything you want to add on anything we touched on?
The only thing I would always suggest to anybody is you want to get pre-approved first. Even if you're thinking about buying a home 6 months from now or a year from now. Start today, because if you think your credit's not great, start today so we can guide you on how to fix your credit. What to do to get your credit score, say, from a lower number to a higher number. And sometimes it takes a little bit of time. But I would say if you start today. You know, if you're thinking a year from now, if you're thinking in the summer, start today. This way you know what you can do.
So I can totally vouch for that. You know, I'm 1099, so I pay my own taxes. It's almost, I basically own my own business. And, going 1099, it's a whole separate, and we'll wind up doing a series, a video just on 1099 because it's a whole different process. But, dealing with Mark, knowing that I was buying a house 3-4 years ago, we had this plan in place for about a year and a half, for my income, where I had to hit, where my tax had to be to get the best rate and all this other stuff. So we had a plan in place a year before I was actually buying a house to make sure I hit that mark, and it worked out. It
Yep.
definitely worked out.
Yep.
So
Yep.
it's almost like being a financial advisor.
Yeah, to a
Or,
degree.
A
Yep.
home financial
Yep.
advisor.
Yes, absolutely.
So
Absolutely.
cool. Well, this is Shawn Anen, Better Homes and Gardens Rand Realty, team leader of the Anen Group with Mark Casamassina from NJ Lenders.
Yep.
Speak to you guys soon.
Thank you.